Welcome back to What Changes. I'm your host, May. If you have been watching the financial headlines lately, you might have noticed a shift in tone. The confidence is starting to crack. The usual assurances from Washington are beginning to sound less like policy and more like panic. We are witnessing something historic, something that goes beyond the usual ups and downs of the stock market. We are watching the fundamental architecture of the global financial system being tested, and in some corners, rejected. Today, we are going deep into the data that the mainstream often glosses over. We are going to talk about why top US officials are suddenly begging global investors to come back. We are going to talk about the physical draining of American gold, and we are going to talk about what this means for your money. Before we dive in, I want to remind you that the conversation doesn't stop here. For the latest updates and uncensored charts, make sure you join our private Telegram channel. The link is right there in the description below. Join us there. Let's start with the bond market. This is the bedrock of the global economy, and right now, it is getting pummeled. For decades, US Treasuries were considered the safest asset in the world. They were the risk-free return. But over the past month, we have seen a massive repudiation. Investors are rejecting US assets. It is important to understand the nuance here. The absolute numbers of bond purchases might show some movement, but the percentages, the share of demand, are collapsing. And you cannot run a global reserve currency if the demand for your debt collapses. You simply cannot afford it. Who is selling? That is the billion-dollar question. Historically, the G7 nations were the reliable buyers. They were the allies who soaked up American debt. But look at the map now. Canada is moving away from the US economy. Their demand is falling. Japan, usually a staunch buyer, is facing its own currency nightmare with the yen, meaning it might flip to become a net seller just to save itself. The only major buyer left in that bloc is the UK. Meanwhile, look at the growth engines of the world. The BRICS nations, China, Brazil, and India. These are the economies that are growing, and they are all dumping their holdings. We are talking about nearly $200 billion worth of US bonds sold. The projection for 2026 is that this dumping will accelerate. Why is this happening? It is not just politics, it is survival. China obviously wants to de-dollarize. They are looking at the sanctions placed on Russia, and they are taking notes. They do not want to be the next case study in having their assets frozen. They are reducing their risk. But it is not just China. India has officially denied selling Treasury bonds, but if you look at the sale numbers, the data tells a different story. New Delhi is selling. They are doing it to bolster their own currency in the midst of a trade war. Brazil is dumping because its trade with China is booming. When you have two massive economies agreeing to trade in their own currencies, holding US debt becomes unnecessary. It becomes dead weight. This leads us to the second major crisis, the valuation of the dollar itself. You see, the biggest hurdle facing US assets right now is the collapse of the dollar's value. In just 2 months, the dollar has dropped by 1.5%. Over the last 12 months, it is down over 10%. Think about this from the perspective of a foreign investor. Let's say you are sitting in Europe or Asia, and you decide to buy the Nasdaq. Maybe the tech stocks are down slightly, say 1%, but because the dollar itself has lost value, your total loss is magnified. You have lost on the stock, and you have lost on the currency conversion. A weaker dollar amplifies losses for foreigners. This is why money is afraid to flow into US assets. As the dollar continues to fall, it makes US stocks and bonds toxic. If you are a foreign fund manager, why would you buy an asset denominated in a currency that is sliding 10% a year? You wouldn't. And if this flow of foreign capital stops, the only buyers left are domestic US investors. That insularity leads to higher domestic inflation and hammers the currency down even further. It is a vicious cycle. The situation has become so critical that Scott Bessent has effectively issued a public service announcement. He is out there trying to defend the dollar, practically begging global investors to return to US assets. He is promising that the reserve currency will stay strong. When asked what a strong dollar policy means, his answer focused on making the US the most attractive place for capital through deregulation. He claims that for every new regulation, The administration has cut 23 old ones. But here is the problem. Bessent's focus on regulation is a red herring. It is a distraction. The real problem isn't the number of pages in the regulatory code. The real problem is the collapse of US industries and the manufacturing sector. The US simply is not exporting enough to the world. And a major reason for that is the tariff war. You cannot justify a strong dollar when your input costs, the cost to actually make things, are 30% to 40% higher than your competitors. It makes everything you produce uncompetitive. When exports collapse, people lose jobs. It is not rocket science. The latest reports from the Bureau of Labor Statistics show a decline in US manufacturing that is worse than expected. Since 2023, the sector has lost more than 300,000 jobs. And notice the timing. The biggest decline came right after the tariffs went up. This is not a coincidence. We are seeing global boycotts sparked by this trade war, specifically up north in Canada. But even without official boycotts, price is the ultimate barrier. If a product made in the US costs 20% more because of a strong dollar and tariffs, foreign buyers walk away. To normalize trade, the currency has to fall. It is simple math. Prices rise for US goods, so the currency must drop to make them affordable again. This exposes the true vulnerability of the reserve currency. Despite the recent drop, the dollar is still trading near 30-year highs on a relative basis. But if the manufacturing sector continues to crumble, the dollar has to adjust downwards. There is massive downside potential here. And because the US economy is so hyper-financialized, a falling dollar does not just hurt exports. It cripples the demand for all US assets. It is an interconnected mess that is extremely hard to untangle. Now, the administration has another argument. They claim that energy independence will save the dollar. Bessent argues that the US is an energy export giant, capable of exploiting natural resources like clean coal and natural gas to set the economic fundamentals right. He argues that currencies fluctuate, but fundamentals win over time. We have to push back on this. Yes, the US can pump more oil. You can issue permits. You can even try to bring in Venezuelan oil. But the reality is that US oil exports are falling. They are down 10% compared to recent years. And regarding Venezuela, that oil is heavy crude. Most refineries around the world cannot handle it easily. It is not a silver bullet. Furthermore, look at the power grid. In the age of AI and massive data centers, electricity is the new gold. You need energy to run the economy of the future. Over the past 4 years, China has installed more power capacity than the entire United States possesses today. The US has about 1.3 gigawatts of capacity. China now has nearly triple that, sitting at 3.9 gigawatts. Bessent's claim of energy independence is a snapshot of the past, not a movie of the future. If the US grid build-out continues to lag, eventually China will surpass the US in technology, specifically in AI and semiconductors, simply because it has the power to run the machines. If that happens, the demand for dollars and US assets becomes even more compromised. Bessent's speech ignores these massive plot holes. We have to brace for the dollar to fall further. So, if the dollar falls, what does that mean for you? It means your real returns are evaporating. The S&P 500 might rise by 10% on paper. But if the dollar loses 5% of its purchasing power, your real return is only 5%. This is the silent thief of wealth. While Washington plays defense, China is going on the offensive. During hearings, it was admitted that China is making moves against the US financial system. They are setting up alternative payment rails. Yes, but the bigger issue, the one that keeps central bankers up at night, is how China might be backing its digital currencies with gold. Beijing is firing on all cylinders to challenge the dollar because it knows the timing is perfect. Why? Because US spending is out of control. The Congressional Budget Office, the CBO, just released a report that should terrify anyone holding dollars. The deficit is going to get worse. By 2036, the US deficit is projected to reach $3.1 trillion annually. This year alone, it will hit $1.9 trillion. Let's break that down. An increase of $1.2 trillion going forward. That is equivalent to 6.7% of US GDP. This money has to come from somewhere. It has to be raised by selling bonds, which we already established nobody wants, or it has to be printed. If they print it, we get inflation. If they don't, The US plunges into an immediate recession. But it gets materially worse. When you look at the breakdown of the deficit, the majority of it is coming from interest payments. A crazy 4.6% of the deficit is just paying the interest on the credit card. The primary deficit, the actual spending on services, is only 2.1%. We have reached the point where interest payments are the majority of the money borrowed. This is a spiral. The US government faces a binary choice: default and don't pay the debt, which destroys the financial system instantly, or work with the Federal Reserve to print dollars. They will pay back your principal, and they will pay back your interest, but they will do it in a currency that has been devalued into oblivion. You get your numbers back, but not your purchasing power. China knows this. They are looking at the math, and they are moving in the opposite direction. They are accumulating sound money like never before. They are accumulating physical gold bullion within the country itself. Gold inventories in the Shanghai Exchange are exploding, up by a record 104 tons. And this isn't just the government. This is Chinese investors and entities moving global supply into China. Beijing wants the country flushed with gold. This is a contingency plan. The People's Bank of China is buying, the commercial banks are buying, the Chinese military is buying, and now the Shanghai Exchange is full of the metal. Why? It is not just to make a balance sheet look pretty. It is to signal to the world that they are fiscally responsible. Gold is a real asset. It is no one else's liability. There is no counterparty risk. Goldman Sachs has reported that China is likely understating their gold buying significantly. It could be 10 times more than what they are officially reporting. This clandestine buying points to a preparation for a currency reset. Bessent expressed fear about China using gold to back a digital currency. The data suggests that is exactly what is happening. And here is the irony. Here is the part that should shock you. A lot of that gold China is buying, it is coming from the United States. In the past few months, the top export of the US was not cars. It was not microchips. It was physical gold. This is incredibly bad news. Exporters sold and transferred away $12.5 billion worth of gold in November alone. Net on net, the US is settling its trade deficit in gold. This is what happens in an end-stage collapse. Trading partners would rather drain the physical assets from a country than hang on to its paper currency. The gold is being shipped from the US to hubs in London and Switzerland. But the biggest buyer of physical gold from those two places is China. In a roundabout way, Beijing is draining the US of its gold reserves. The trade deficit between the US and China is effectively being settled in bullion. Chinese exporters are no longer recycling their earnings into US bonds. They are demanding gold. They are buying it from the US markets. This puts Washington in a terrible pickle. If a currency reset happens, if the world decides to revalue currencies based on real assets, where is the gold going to come from? If the US tries to buy gold back later, nobody will want to sell it for dollars. The price will be astronomical. And China isn't just buying the metal, they are buying the supply chain. They are going around the world buying up companies with mining rights. The latest acquisition was a Canadian miner, Ali Gold, bought by a Chinese gold company for $4 billion. This gives Beijing access to gold assets across Africa. The playbook is clear as day. When the revaluation happens, China will be sitting pretty. They will have tons of mines ready to supply their financial system with physical gold. Meanwhile, the US Treasury and the Fed claim to have 8,100 tons. But that is all they have to fall back on. And frankly, we don't even know if it is all there, because there hasn't been a proper audit of US gold reserves for decades. For China, the time to strike is now. Since 2022, demand for US bonds has stagnated. Yields are staying high, which hurts the US government's budget. The dollar's strength is trending down. Even if the Federal Reserve cuts rates, it won't help the dollar, and it won't generate organic demand for bonds. You cannot reverse a downtrend with superficial actions or speeches. To actually fix this, the US would need to reverse the trade war and cut deficit spending massively. But we all know that is politically impossible. It isn't going to happen. So we are left with the current reality: a crumbling manufacturing base, an energy grid that is falling behind, a debt spiral that requires printing money, and a rival superpower that is quietly draining the world's real assets. This brings us back to the question I asked at the start. Will investors throw Washington a bone? Will they listen to the begging and buy more bonds? Or will China continue draining gold away from the United States until the vaults are empty? The trend lines are clear, but the timeline is the only uncertainty left. I want to hear from you. Do you think the US can turn this around? Or is the shift to a gold-backed Eastern system inevitable? Let me know your thoughts in the comments below. We are navigating through crazy times, and having the right information is your best defense. If you found this analysis helpful, please smash the like button and subscribe to the channel. It helps us get this information out to more people. And don't forget, for the charts and discussions we can't show here, join the Telegram channel listed in the description. I'm May, this is what changes, and I will see you in the next one. Stay safe.